Dr. Michael Burry, a man shrouded in mystery following his sudden disappearance from Twitter in mid-March. Before deleting his profile, Burry had been shouting warning after warning about the rampant speculation and excessive valuations in the financial markets. Most notably, in February, he had stated that the stock market was, quote, dancing on a knife's edge, and slammed stock trading app Robinhood as a dangerous casino. But it was not until his dire warnings about upcoming hyperinflation, comparing the United States to the Weimar Republic, that officials really began to grow concerned. According to various reports, Burry was visited by SEC officials who supposedly warned him about his Twitter behavior and how it could be influencing the markets. These last tweets before the profile was deleted are very, very interesting and open a portal into the mind of a man well known to predict severe market downfalls. In today's video, we examine these horrifying tweets that suggest a rather uncomfortable truth about the future of America and its thriving economy. The story starts on February 20th, 2021. The tweet is seen here. Linking a book called The Dying of Money, Burry suggests that the US government is inviting inflation with their new insane monetary policy. You see, since the start of the pandemic, the US Federal Reserve has been on a printing spree, creating more dollars out of thin air in the last 13 months than in any other period in US history. With 3 stimulus checks sent out to common Americans and a potential 4th on the table, the implications of money printing are starting to be felt. This, also combined with pent-up demand and a growing debt-to-GDP ratio, make for a rather unhealthy American economy. Sure, things look okay right now, but if you know your history, then you can see what's hidden beneath these murky waters. Everything we're seeing right now points to a severe inflation crisis, yet the government is claiming inflation remains a low 2%. This reported rate is starting to become laughable. Look around and investigate the prices. Gas, houses, lumber, groceries, cars, the list goes on. But all of these items have seen significant price increases in the last year alone. The Fed chair, well, he claims it's temporary, repeating this phrase over and over, burning it into the brain of every listener.
And how much inflation is the Fed willing to tolerate before it acts to restrain price pressures?
So on inflation, a couple of things. There are a couple of things that are worth mentioning. One is just that we know that we measure inflation on a trailing 12-month basis, and as we lap the very low inflation readings of March and April of last year, we'll see measured 12-month inflation move up a few tenths. This is just, they're called base effects, and that's a transient thing that we think will pass. There's also the possibility, indeed it's in some forecasts, that as the economy fully reopens, there'll be a burst of spending, and because people will be enthusiastic that the pandemic is over potentially, and that could also create some upward pressure on inflation. Now, again, we would see that as something likely to be transient and not to be very large. In both cases, we don't see those as either lasting or particularly large.
Eventually, things are just going to become very obvious. The Fed chair will ultimately be forced to admit inflation, and the results of that will begin the ultimate spiral. That brings us to the second Burry tweet of that day, a reminder that the inflation cycle is not going to come all at once. Germany's ran not for 1 year, but 9 years, and the last year was a complete collapse. This graph puts that tweet into perspective. This is the value of 1 ounce of gold compared to 1 German mark in the time period of 1918 to 1923. For years, the German mark suffered serious inflation. Remember, this graph is in log scale, so it's not going to go up in even numbers on the right y-axis over there. It's jumping up exponentially. By 1923, the German mark is useless and had suffered a complete collapse, good enough to be used as toilet paper. But remember, the buildup lasted years. Sure, 1923 was a long time ago in our minds, but the United States is not free from this scenario, as crazy as it sounds. Hyperinflation is well known as the #1 way empires get brought down, and this empire is no exception. Based on the events of last year, we have set the primer. Now all that's left is a catalyst to bring it down. What could that catalyst be? This generous dollar printing we're seeing right now is pumping money into stock markets, and Burry is quick to realize this. His last tweet the next day on February 21st states that professional investment teams are taking bigger and bigger risks getting creative to engineer extremely leveraged positions. It's almost like he called what was about to happen next.
Because this developing story is causing ripple effects throughout the markets. We're seeing it this morning. Archegos Capital Management is a family office that had amassed huge positions in media stocks and China internet names. When some of those positions moved against it, and we saw that happen last week, we can talk about that in a second, why that was. The firm was hit with huge margin calls, was forced to liquidate more than $20 billion in stocks. At the center of all of this is Bill Wang. He's the founder of that firm, which was set up as a family office after his own was closed. He was a part of Tiger Asia. He's a protege, disciple, if you will, of Julian Robertson. In 2012, he pleaded guilty to wire fraud on behalf of Tiger Asia. Now, all of this seemed to unravel late in the week when Goldman Sachs, which for many years had refused to do business with Bill Wang, by the way, because of those insider trading, not just allegations, but the guilty plea itself, pushed him to sell some of these stocks. He had been long and leveraged long in a very big way, especially when it came to stocks like Viacom and Baidu. Now, Viacom, as we saw last week, was hit hard. In part, we should say it was hit hard because it issued that stock midweek, and frankly,
Archegos Capital 1 month later would implode in the middle of a bull market, a firm that managed over $10 billion in capital. According to reports, losses may have topped $50 billion due to extreme leverage. If you read into the details, you can quickly see that this situation was created via complicated financial engineering. The fact that Archegos positions were derivatives rather than actual stocks allowed it to build large stakes, some of them giving it exposure to over 10% to these companies' shares, without having to disclose those stakes to regulators, which is something they would have had to do with regular stock positions of that magnitude. This allowed Archegos exposure to those shares to remain anonymous until the trades blew up. This blow-up is one more sign of just how much leverage has been built up during this market mania and how exposed investment banks are to this leverage. If times are good and massive investment banks are losing billions and going bankrupt, what will happen when we get a sudden and unexpected downturn? The Archegos story was passed over in one day, but it's a lesson and an event that should be looked into further. If a professional investment team can lose $50 billion during a massive bull run, then what is there out in the waters, hidden beneath the surface, ready to implode the entire market once things go bad? Massive derivative positions are being built as we speak, and that catalyst that I alluded to earlier is right in front of our eyes. How long before the house of cards falls? Thank you guys for watching, and please make sure you hit that subscribe button if you enjoyed.